200,000 will not make a difference. So they are sunk, they are irrelevant, and they will likely not show up in our calculations. Or if they show up, they should show up in those cases. Yeah? If we say yes, we pay these. If we say no, we pay these. Yeah? So we can leave them in or out. They will have no impact. And yeah, so in our case, it's only 70 and not 89, and the price is the cost is 40. Yeah? So there is a simple calculation of the profits. That's easy. An investment. Yeah, this is basically a machine that is able to produce jerseys for 10 years, and we simply assume that the contract is only for 5 years. Yeah, so in order to calculate the project, we simply assume that we sell the machine at the assumed cost. And here, of course, it is easy. Well, normal depreciation would mean that a machine that lasts for 10 years has depreciation of 10% every year. If we sell this for 50% after 5 years, there will be no profit or loss from selling the machine. This is just residual book value. Of course, in reality, the depreciation can be more or less than the true value losses, and we will account for this. So this is only a simplifying thing. What is rather typical is that there are always some kind of externalities. If Paris-Fau and Bremen are neighboring cities in the north of Germany, and when Hamburg goes with Adidas t-shirts, and then Werder Bremen is more likely going with Puma t-shirts, and then they don't like Adidas because Adidas is connected to the enemy, and therefore the Werder Bremen fans will then basically no longer. So and here very simple. we just have a simple assumptions. Reduce EBIT by 1 million. Yeah. This here is a bit unclear what this actually means. This design things. But one thing is clear: every year the tricot changes. And there must be at least, think about the designer that basically creates the tricot, and he must be paid 50,000. Now, this is only for the subsequent seasons, because for this year it has already been done. For the 200,000 that you already invested, you have as a result a t-shirt design, and Hamburg seems to like it. So if they sign the contract for the first season, it's already done. But for the next season, every year you will have to invest this 500,000. Sorry, and it is a bit unclear, whether you have to invest this 1 year before or in 1 year. But one thing is clear: for 9 more years, you have to invest this 50,000. And then there was also rather typical when we plan. We usually first plan the expected case. So this 150 t-shirts sold, that is basically in an average year. But life is not always average. There is a good case, and in this case, the Hamburger Sportverein advances to the first Bundesliga. Then they will be more prominent, and more people will watch the games, and more t-shirts will be sold. In the worst case, of course, they go bankrupt. Or they may go to the third Bundesliga at a lower level when they are not successful. And quite typical in these capital budgeting things, you plan for 3 cases: average, good, and worst case. And then you may assign some probabilities on this, and basically say the numbers on which I base my calculations, maybe with 50% probability the expected case, with 25% probability the good case, and with 25 the bad case. Here it is actually nothing is said here. Basically you are asked to calculate the base case as the most likely case, and then just consider this up or down risks somehow. Tax rates are always a bit difficult, yeah, simply because there is nothing like one single tax. We have in Germany at least 5 or 6 different taxes on profits. And here it's just one, the solidarity charge. In the real world, it is even much more complicated. Think about VinFast. Yeah, they sell their cars not only in Vietnam but also in other countries. And they make profits in Vietnam and in other countries. And they have to pay the national tax on the profits that they make in every country. And then, of course, anticipating the tax bill is highly complex. Every country has more than one tax. Every country has different tax rates. And in these things, you can't become an expert in these kind of things. So you do a rough estimation, but here basically you are asked to also add this 5% charge, and it's not really clear how this is added. Is it 20% or is it 15% times 1 plus 5.5%? Cost of capital is given. And what's also typical, this question. When you do suppose you are working for Adidas and you are supposed to calculate that through. Then most bosses will ask you for what should we pay for this. We have an attractive contract to sign, but Hamburger Sportverein, they want money for this. What should we pay? As a valuation expert, you can only say what is the maximum amount. Because the less you pay, the better. So you ask your boss, better you. If we have to make a payment, the best payment is almost 0. That's obviously the best. But from the valuation, you can only say, if we pay more than X, then this is value destroying. The maximum is X, and then X is basically the amount where we have no value generation. And then basically the boss says, but we do it for other reasons. Because we have some marketing advantage, because our logo will be on the TV. But then you say, dear boss, you have to value the extra benefit. I am there to calculate the impact on shareholder value. I just look at the cash flows, and I basically tell you if we pay no more than X, then, and we explain this to our shareholders. Adidas is a listed company, you can buy the shares in the market, and of course they have the policy, hopefully, to look at the likely share price impact. And basically this maximum is simply the amount that if all shareholders have all the information, and if they believe this information, then the share price should not go down, and the value of an Adidas share should not go down. So, this is basically the basis, and I just present what, actually not my solution, but what my colleague, to be very honest, it was a PhD student of my colleague, Professor Haselmann, at Frankfurt University, who prepared that case. And it has all the good and the bad things of what happens when people like you prepare such a case. In the end, a PhD student is nothing else than a master's student 2 years later. You may agree or you may not agree. But I think they did a rather good job. But if you disagree, then basically it doesn't tell you. The only thing it tells you that you have interpreted the evidence slightly different, or you basically say, I have another idea on how to approach this topic. That's absolutely fine. This is basically a proposal. When you are an investment banker or a professional working for Adidas and you do the analysis, then you can say, this is my result, this is how I see it. If you have a different opinion, that's fine with me. Don't even think about that there is a truth, or that there is the correct solution. Of course, different solutions may sometimes be stupid. And you learn from seeing how intelligent people approach these cases. But even intelligent people can do errors. and real life is full of errors. So the PhD student at Franklin basically calculated a net present value of roughly 7.2 billion. So they would say this is the maximum price that we can pay. And the IRR is calculated to be 24%. So that seems to be a highly profitable investment if you pay nothing. If you pay 7.2 billion, then of course the IRR goes down to the cost of capital, 5%. Because the maximum price simply means no value generated. The IRR with no value generation should be 5%. Just the cost of capital. And then the slides go to risk and chance and the contract policy. Oh, sorry, 8.34. I don't know. Oh, because it was not found yesterday. So please, let's see what this student has done, why he basically says 8.34 is the maximum price. So this is why I wanted to show the PowerPoint, because this is somewhat corrupted. This looks better. So, the fact is the sunk costs of 200 have already been made. And don't forget this. You have to calculate the depreciation and the salvage value is simply the remaining value that will come. This 50,000 will be paid in years 1 to 4, not in year 0, the current year. Because for the next season it's already designed. There are basically two conventions. The next year can be year 0 or can be year 1. Our PhD student basically assumes that year 1 is the next year and not this year. He calculates a marginal tax rate of 15.82% because this is how he interprets the solidarity charge. And I think this is German law. To be very honest, I actually don't believe that corporations pay solidarity charge. I think this is completely wrong. If you just Google, is the corporate tax rate including the so-called solidarity charge? I think no. But let's take it here as given. When investment bankers calculate the tax rate for German profits, for these kinds of calculations, they usually Google and they find that the large audit firms, KPMG, PwC, they all have something that they call international tax tables. And then you look for Germany and you see something like maybe 15.8% and maybe 20 something, and then the claim is that is what our experts believe is the marginal tax rate in Germany for corporate profits. And you usually would take this. Simply because as an investment banker you are not a tax expert and you don't want to go into the details of all these different taxes and you are not interested in the details on how the solidarity charge, you actually don't know whether it's a part of corporate profit taxation and you don't know whether it's added to 20.5% or whether it's multiplied. You simply have no idea. So I would always prefer to just say, this is an incomplete picture, the information is not sufficient, but I know that there were international corporate tax tables, I just look it up in the internet, and if KPMG says, the corporate profit tax rate is 20%, I use 20%. In a real world situation, well, these things are of course prepared by people that don't know what the relevant information is. You need to design this contract. You have some employee of Adidas who prepares the information, hands this over to the valuation expert, but the person may not be able to know what the relevant information is. He may have added a sentence, the solidarity charge is 5% or 5.5%, but this may be completely irrelevant because corporations do not pay this on corporate profits. And that's what I believe, and therefore I believe that the solution here is also yeah, cost of capital 5%. Just to remember, when the case says Adidas has a cost of capital of 5%, and this project can have a cost of capital that is more or less than this 5%. When we think about the cost of capital, we think about these assets. Adidas is a producer of sportswear, and that has a certain risk, and the cost of capital is driven by the risk. The key question is always the risk premium. If it's risk-free, then you pay the government bond rate, and corporations, when they have risk, they have to pay more, and the risk premium is the reflection of the amount of risk. Now, if this Jersey project is as risky as the other Adidas activities, the risk premium will not change. But if the new project has different risk, if it has more risk, then it should deserve a higher cost of capital. An extra risk premium because it's a more risky project than the other projects. And given that the case doesn't tell anything about this, we know it's risky, but we don't know whether it's more or less risky, and therefore we just assume the average cost of capital and use this 5%. Straight line depreciation, that's of course easy. The book value of this investment starts with 10 million, and after 5 years it just has been reduced to 5 million, 10% gone every way. If you sell this for 5 million, then there is no gain on the sale, so there is no taxation. If you think about, you sell this machine after 5 years for 5 million, and this will be more, if the sales price is more than the book value, then this would create a gain, a profit. And you would have to pay a tax on this. Given that we have no profit here, this is not a profit. But when you think about forecasting the future, you always have to think about what is tax relevant. Whenever you have a profit, it must be taxed, and you would have the after-tax cash flow from the asset sale. So if we assume that the machine can be sold for 8 million, maybe an assumption, maybe somebody tells you this, because the truth is the machine is depreciated over 10 years, but it lasts for 20 or 30 years. Then the value in the market may be still 80%. And then we would have a booked gain, and we would have to consider the taxes on this, and then only the after-tax cash flow would still account. But here it's very simple, and we simply assume that we get 5 million, because in the end, of course, we need the cash flows for the calculation. And this is basically the cash flow stream that this PhD student basically projected. I think revenue is clear. Number of shirts times the shirt price, 150,000 times 70. This externality is always reduced. It is treated like a cash outflow. The cost of goods sold is straightforward. This gives you gross profit. And then this R&D, the first year had already been paid here, and then 4 times 50,000. That is what the model assumes. If you would shift this to the right or to the left, that's just another interpretation of the data. The case is a bit unclear when precisely this 50,000 happens. Here basically you say, this is today, this is in 1 year. So in 1 year you start to pay the first 50,000. Then this gives us the, then we still have to calculate for the depreciation. It's not yet in. So 1 million of depreciation in the next 4 years, in the following 5 years gives us the earnings before interest and taxes. Then we pay the tax, assuming 20 point something tax rate, 50 point something, what we had. Anyway, and then we have unleveraged net income, and then we add depreciation and capital expenses. Here in this case we have no inventories. Yeah? In the real world you would say in order to produce the jerseys we have to buy some textiles, some clothes, and then we need a little bit of inventory increase, and we would have this change in net working capital also. It's simply excluded here for simplicity, but this unleveraged net income must be adjusted by these things, very much like we did in the yesterday. And then we have a key free cash flow. And the free cash flow is what we have to pay for the machine today. And these cash flows, and of course in the last year, the biggest cash flow is this 5 million that we get from selling the machine. And because selling the machine has no tax implication, the taxes here are still correct. If the machine would have tax implications, it would also need to be reflected somewhere. And the present value is simply the discounted value by 5%. Always discount this. This is 1 year discounted with 5%. This is 2 year discounted full stop. And then this is the net present value, 7.2 million. And in the present value calculation, of course, now we calculate with 5%. If you think about, if you calculate the whole thing through with different calculations, if the discount rate is 5%, we end with 7 point something. This is the point that we just calculated. If you just enter 10% into the calculation, you will have a remaining net present value of roughly 5 million. And if you have 25% roughly, the net present value goes to 0. And this is why you basically say 24.5% is your internal rate of return. The internal rate of return is the capital cost that gives you a 0 value, net present value of 0. And of course we see the internal rate of return is bigger than the cost of capital of 5%, and therefore this is a project that you should undertake. It's a value generating project. We do every project where the net present value is positive, or where the internal rate of return is higher than the cost of capital. It's just another way to say the same thing. The finance professor would say, we do this because the net present value is positive. A practitioner will usually do this. We do this because it's a good investment of our money. We make 24%, but our cost is only 5%. 24 is bigger than 5, and therefore we do it. But in this simple case, it doesn't matter at all. Whether you say I compare the IRR with the 5%, or I just look where the net present value is above or below 0. And of course now you can simply change the spreadsheet and say what would happen if there was an advance to the first Bundesliga. And here the advance is from the second year on. So if you assume in the second year on the advance to the new Bundesliga, then the net present value is going up. So everything is unchanged except these numbers here. 21 is the first Bundesliga case, and then you can simply look at the value impact. And of course you can say, if I assume this to happen with 25% probability, then you can basically say the net present value is 25% times this, plus maybe 50% then the other, however you value these things. And of course, if you go bankrupt or you relegate to the second Bundesliga, then from year 2 on, the numbers here are reduced, but you still get a positive and almost 0 present value. But of course, if you pay 7 million for this contract, then of course this present value is far less, and it would be value destroying. Only if you pay nothing, then this is still value generating. Yeah, so one thing that you can basically write to your boss is, yeah, dear boss, if we pay less than 102,000, then even if this bad case happens, yeah, we still do not lose money, yeah, or we do not lose value in the strict sense. Yeah. I don't know whether your boss will understand what value generation is. The boss is usually somebody who is not familiar with these calculations. And therefore, if you're a valuation expert working for Adidas, yeah, you know this is how it should be calculated, but it's not yet clear how it should be communicated. Yeah? Your boss simply asks you, how much should I pay for this? Yeah? And your wording is basically your decision, yeah? Based on what kind of language you believe is appropriate. And maybe you just say to your boss, yeah, if you are pessimistic and believe that the worst case happens and you still do not want to lose money in this case, yeah, please don't pay more than 10,000. This is, okay. This is why you can pay 8.55 million. Yeah? If this is the net present value, and if you pay to household Hamburg this one, yeah, it is tax deductible. And of course, payments for contracts are normal, ordinary payments, and the after-tax value of this is 7.2 million. Yeah, so the maximum that you can pay, yeah, is such that after tax, yeah, it will not cost more than 7.2 million. Yeah, and therefore, never forget the taxes. Yeah, the maximum price is a pre-tax price. And therefore 8.55 million. This is the upper limit of the sponsorship fee. Of course, only in the case where you say first Bundesliga or third Bundesliga has a 0 probability. Yeah? You just base it on the base case. Yeah? You could also say I assign probabilities. 50% this case, 25% the other cases, and then you take an average out of this. It's also quite often done. Yeah? And yeah, this is just one proposal how to do it. If you did it differently, with 1/3 probability or whatsoever, this is fine. Yeah? But if you realize, oh, I forgot this, then you have some takeaway and say, oh, next time I remember. Yeah? I think going through examples is really learning whether you did an error that you would not do again once you saw basically another people solution. Yeah? And if I now would ask all you to present your own solution, yeah, and we compare them all, well, and after comparing them all, we may say, this may not be the best one. Yeah? There are better ones. Yeah? But we want to be convinced. In the end, yeah, we want to propose to our boss only what we find ultimately convincing after looking at all the evidence. Yeah? And I think these kinds of, in the real world, you quite often, you start like you did yesterday. Yeah? You did your quick calculation and you came up with something. And then maybe you also ask some valuation expert, yeah, maybe this is important enough that you ordered some investment banker to do, but also a quick and rough estimation. Yeah? And the investment banker gives you this solution. Yeah? And then you compare your solution and that solution, and basically you say, yeah, there are some good ideas in there, yeah, I forgot something, yeah, I changed my mind, and I do a refined kind of thing. Or you say, both solutions seem not to be convincing really. Yeah? I have the conjecture that I have to look for the real tax rate of Germany. Yeah? Maybe I hire a third expert, I pay really a lot of money to get the full truth, because this is all just estimates, yeah? And they are all highly questionable. So in the real world, it's both, yeah. What kind of input do you use? Yeah, how much trust do you have in the inputs? Yeah, and do you spend extra time or extra money in order to become more confident, yeah, with these inputs? Yeah, and the other thing is technology. Yeah. Do you use a spreadsheet in order to calculate the net present value? Yeah. Do you account for the fact that you have a tax margin on this thing, and then you have lots of things where you say, oh yes, there is something that I need to change. Yeah, so 8.33 is something that the upper limit that you pay based on the base case, and of course you still know this is risky. If you pay this, you will actually make money. If they go to the first Bundesliga, you will lose money. If they go bankrupt or relegate to the third Bundesliga, and then as a valuation expert, one nice idea is you were asked only to do the valuation. But if your boss gives you that thing, and you know that the value depends highly on the risk. As a valuation expert, you are concerned with the impact of this project on the Adidas stock price. And from all you know is that shareholders hate risk. And then your contribution to this case is actually, dear boss, please think about the risk. HSV should bear the risk, not we. If we take the project as it is right now, we would lose money if they go bankrupt, we would make money if they go to first Bundesliga. Our shareholders hate this. But HSV should not have a problem to bear the risk. We may simply ask for a different contract. We may say, if you go to first Bundesliga, we pay more. And if you go to third Bundesliga or you go bankrupt, we pay less. Then we basically offload the risk on HSV. HSV will may say we have no problem with this. Because if we go to first Bundesliga, we are rich, and we have no problem to accepting to pay a higher price for you. So then we will be stage contingent contracting. Depending on the state, stage, first Bundesliga, second Bundesliga, or bankruptcy, you would have an annual fee in step one. The case asks you for one installment at the beginning. So you pay 8 million right now. One obvious idea is let's make this an annual payment. And let's make this annual payment dependent on the Bundesliga. Is it first, second, or third? And then you increase the annual fee if you advance, or you decrease the fee if you relegate to a bad league. And then HSV may be ultimately bearing all the risk. This is something that is attractive from a shareholder value perspective. And this is something that your boss is not even thinking about. You may also say, dear boss, there was actually, sports risks are high risks. Sports is big business, and big investors bear a lot of risk, and there are really insurance companies that basically also take this risk. So there is something like you can buy insurance. That we could simply go to an insurance company and say, we fear that HSV will relegate and go step down or go bankrupt, and we want a protection for this. This would allow us, of course, the value, the financials deteriorate. If you have an extra insurance premium paid in, you can just think how this would show up. Let's go to the base case. So you would add to the cost of goods sold an insurance premium. It would decrease your net income. But it would decrease the risk. And where would you show this? When you calculate the present value, now you calculate with 5%. But if you say this is a highly risky project, you may say, I would need a much higher risk premium. I need 10 or 20%. 5% is ridiculous, basically. Private equity firms usually want to make 25%. And they say, our business is highly risky, we want a return on equity of 25%. So in the real world, you would say Adidas may have a 5, even the 5% for Adidas is quite low. The case was done in the area of low interest rates. When the safe rate of interest was 0 in Germany, 5% may simply reflect 0, interest rate plus 5% risk premium. And 5% risk premium seems okay for Adidas. Yeah, but in a normal time like today, yeah, currently we have 3% interest rate for the government bonds in Germany, yeah, plus 5%, it would be 8%. Yeah. But this project, for me, seems this is likely in higher risk than average. Yeah. So you may say, without insurance, yeah, I require a cost of equity of not only 5 or 8%, but of 15%. Yeah. But with insurance, I reduce this to 10%. Yeah. And then, yeah, with insurance, you may return in a higher net present value. Yeah. Depending, of course, on the impact on the risk premium. Yeah. So, valuation experts, yeah, also think about risk, yeah, and the insurance premium, yeah, destroys the profit, and most managers basically only think about profit and say, yeah, let's get around this. Yeah. But as a valuation expert, yeah, you know that capital markets hate risk. If you can reduce the risk, yeah, you have to judge also whether it's worthwhile to buy the insurance. Yeah. And this is a way how you can calculate it, but of course it assumes that you must be able to know the impact on the cost of capital. And in the end, of course, it seems somewhat arbitrary to say. Yeah? Currently, it has 15%, and with insurance, it has only 10% cost of capital, because the risk premium is decreasing. Yeah? But if you Google for this, yeah, if you are working in this case, yeah, you will see that there may be some kind of data-driven, intelligent approach, basically to do this, such that you basically make a convincing point, yeah, that it is worthwhile to pay this insurance premium. Yeah, summing up, this is clearly profitable, yeah, because of course there is a lot of shirts produced, and the fixed cost of the machine is too low. We make many simplifying assumptions. Yeah, details may be unknown, our assumptions may be wrong. Yeah, it is quite often fishing in the dark. Yeah, these kind of projects are never calculated completely through, and even if you spend a lot of time on it, yeah, there are still many unknowns, by definition. The actual sponsorship fee, of course, will be determined. Yeah? People sit together, and this is a value-generating project, but we have no idea whether it will be split fairly between Adidas and HSV. Yeah? It is a value-increasing margin for both. Yeah? When Hamburger SV, the sports club, and Adidas, yeah, when they agree, yeah, they can basically generate something like 8 million in value. Yeah, and it's up to them basically to decide how much goes to whom. Yeah, but the partners that sit on the negotiation table may be completely different in terms of financial expertise. Yeah, sports clubs are usually managed by people that have no idea about shareholder value. Yeah, and HSV is not a stock-listed company. They don't care about the share price. Yeah, maybe they just look at the next year. Yeah, maybe the boss of the sports club is somebody who fights for his re-election next year. Yeah, so the only thing that is really he is interested in is having in this year a maximum amount of money. Yeah, and then you can exploit this, and basically say, yeah, dear guy, yeah, we can pay a lot of money, but only if you basically guarantee that you advance to the first Bundesliga. Yeah, so we pay you now a large sum of money, but if you should not advance to the first Bundesliga, then of course we need to pay back something out of it. Yeah? That's basically real-life bargaining in a situation where you know what the preferences of the people are. Yeah, of course, how much you get for yourself also depends on the others. Yeah, Mike here is of course just a nickname for Nike. Yeah, the other big competitor. And you your offer will depend on what you think, how aggressive they are. Yeah? This is an oligopoly. There were only 3 large sports firms, Nike, Puma, and Adidas. And in such a close oligopoly, you don't have perfect competition. And you may know that some sports clubs always always took Adidas, some sports clubs traditionally take Nike, and only the few that sometimes change are the sports clubs that you fight for. And sometimes, of course, if you can turn around a club, he always used Nike, and now he converts to Adidas. Maybe Adidas is willing to pay a high price, because if we start this project, there is a high probability that it will continue for the next 20 years, and we will make much more profits and projects in the future. So the present value of future businesses, if we do this contract, there is a high likelihood that the customer will stay with us, and we will make more profit in the future. This has been completely neglected here. But in the real world, should also play a role. And of course the sunk cost. How close have you been to this solution? I hope rather close, because the final exam usually has similar cases, and it's fully okay if you misinterpret the numbers slightly, as long as you say there was a room for misinterpretation, but you should not forget the obvious things. In the end, this is not really difficult. Okay, now we come to a large chapter that is called estimating the cost of capital. And we think really the cost of capital as what's the cost of capital of these assets, keeping in mind that they are partly financed by debt and equity, and keeping in mind that debt has a tax advantage, and that tax advantage will somehow pop up. And keeping in mind that risky assets, investors, capital market investors hate risk, so the risk will be reflected somewhere. Both equity and debt can be risky, and the more risky it is, the more costly it will be. With debt it is clear, a company that runs a high risk of going bankrupt, of course pays much higher interest rates, but also stocks that are stocks of a highly volatile, of a highly risky fluctuation, must pay bigger dividends, or the price will be smaller. And that is something that is less intuitive. Because when I asked you what's the cost of equity, when I was a student, I learned that in the old times, before I was a student, the cost of equity was deemed to be zero, simply because there was no obligation to pay a dividend. You sell shares, and now your shareholders may be paid a dividend, but that's voluntary. If you don't want to pay a dividend, you simply pay nothing. In Germany, there's actually a law that says if the company makes profits, then the shareholders are entitled to receive a dividend of 50% of the profit. So if companies basically say we don't pay any dividend, the shareholders can force them to pay at least 50% out, but no more than 50%. And then very old age people then would say, the cost of equity is 50% of our earnings. That is what we can be forced out, that we can be, what we can be forced to pay out. But everything above this is voluntary. And in other jurisdictions, like in the United States, there were companies like Apple, well known for never ever have been paying any dividend. Many corporations never pay any dividend. And if they pay out something, it's via share repurchases. Apple has done lots of share repurchases, but this is all voluntary. There is no law that requires a firm to repurchase shares. And then you could naively say the cost of equity is zero, because there is no necessity to pay. but this doesn't make a lot of sense. Yeah? Because if you just look at the history, yeah, the more the risk is, and here which is simply the standard deviation of volatility of the stock, and the more risk, the higher the average historical return. Yeah? So if you invest into the lowest risk instrument, short-term government bonds, yeah, called treasury bills in the United States, yeah, you make an historical average return of something like 4%, and the standard deviation was very small. Yeah? If you invest into corporate bonds, yeah, you have more risk but also more return. If you invest into the S&P 500 stock market, yeah, you have roughly 20% volatility on average, and you have an increasing return. Yeah? So it's clear that if you invest your money more risky, yeah, you can expect to make more money. Yeah? And so if you think about your Elon Musk, you invent a nice electric vehicle, and you think, how rich will I become? Then you have to ask, yeah, what is the price at which I can sell my project? Yeah? I have a great idea, I realize this great idea, I create great assets, yeah? And I finance them somehow with debt and equity, and then I sell my stocks, and I become the richest man in the world. Yeah? But the price at which I can sell these stocks are, of course, a function of the riskiness. Yeah? If Tesla would have the same profits but a reduced risk, that would mean more value for me. Yeah? And the higher risk is basically reducing the share price. Yeah? High returns is nothing else than lower share prices. Yeah? When you think about just think today's prices are what we think are tomorrow's prices, discounted by risk, interest rate plus risk premium. Yeah? The share price of Tesla could be much more if the risk premium is lower. Yeah? And the return between these basically are the risk premium. Tesla shares, Tesla shareholders make a lot of money, they pay only a small price for the share because they want a risk premium. Yeah? And this risk premium is shown here. Yeah? So the cost of capital is basically in the future. Yeah? If I now want to start a project, yeah, and I think about what is the cost. Yeah? But all we know is the history. Yeah? And the history is really, this is, well, these kinds of things usually are historical averages made over 100 years. Yeah? So if you take 100 years of evidence, yeah, then you see that stocks outperformed corporate bonds, and corporate bonds outperformed treasury bills. Yeah? In every single year, it may be exactly completely different. Yeah? Stocks some years go up, some years go down. Yeah? But the overall, the long-term picture, yeah, is that stocks outperform. Yeah. But interestingly enough, yeah, this dotted line, yeah, seems to connect these red things, yeah, which are diversified portfolios, and every single stock seems to lie below. Yeah? So it seems that the S&P 500 outperforms, yeah, if you have this year and this year are stocks with similar volatility. Single stocks with the same volatility underperform the S&P 500. So just from the historical evidence, it seems that diversified portfolios, the red points here, there are portfolios made of many stocks, and they are diversified. At the same risk, here is one vertical line, they are above these single stocks. And here actually you have no single stock above, but that is just a stylized picture from a textbook. Of course, in reality, you always have some exceptions. Theory basically tells us that diversification makes sense. If you bet all your money on one single stock, then you have, then you can basically diversify and improve the situation, and you can increase the average return. Let's say, let's move on the vertical line. Suppose you want to make 50% return. And you can basically buy this red dot, which is called the mid-cap stock portfolio, or you can buy one of these stocks here, which historically also return 15%, but they have higher standard deviations, and you prefer less standard deviation to more, so instead of taking this, one of these stocks, you take this red dot, and the intuition behind this is, if you this is a diversified portfolio. It simply has the benefits of diversification. And in your asset pricing course, but also in An's pre-course, you learn a little bit how diversification works. So the empirical positive relation. That can be seen only over long periods of time. Over short periods of time, you have all kinds of noise. In the short run, the market is very, very noisy, as we say, and this noise which is random noise. Think about that. Think about that. Every empirical observation is basically the truth with some random error. And the shorter the time period it is, the more randomness you get. It's like when you forecast the weather. In the short run, you can easily forecast the weather, but it's impossible to forecast the weather in the long run. Here we have exactly the other side, the opposite. We can forecast stocks in the long run, because over 100 years, we know that because they are more risky, they will outperform. But we can almost not forecast stocks in the short run. VinFast or Tesla may go up or down tomorrow, and may not behave according to theory just because of random elements. So it's just opposite of weather forecasts. Only in the long run, when things are averaging out, we can see the structure. And the structure is people hate risk, and people require a risk premium on risk. That is the first thing that you can take out of this. And diversified portfolios outperform undiversified positions. And therefore, diversification also plays a role in how people see the risk. You will later see investors hold diversified portfolios. Not everyone. Elon Musk, for example, is a counterexample. Elon Musk has invested all of his wealth in Tesla and X and SpaceX and some other companies. And we don't know how many S&P 500 funds he holds, but probably he has no investment in other securities. So he is fully concentrated. A big exception. If you look at my portfolio, this is very simple. I mainly have the S&P 500, I would say. I have some other stock portfolios, but this is almost the same. I never invest in single stocks. I only invest in stock portfolios, and I take portfolios like the S&P 500. They are traded on the stock market today in the form of ETFs, exchange-traded funds. It's a very cost-efficient way, and most people like me would not even think about buying individual stocks. We basically say there were experts in the field there that know more than we do, and we don't want to trade with these experts. We can only lose. So the best may be just to follow the financial textbooks and just buy an index and invest the money there. And of course, private equity funds are more like Elon Musk. Private equity funds and Elon Musk basically think that they can create value. They need 50 or even 100% control of the firm, yeah, in order to basically become a dictator and change the assets and make money from this. Yeah? They're willing, yeah, to be undiversified, yeah, because that makes them rich. And it's fine for Elon Musk and private equity firms, yeah, but not fine for me, yeah, because I am not a value generator. Yeah? I have only one vote as a shareholder. I cannot affect the decisions of the shares that I own. Yeah? So my strategy is simply to buy a diversified portfolio. Yeah, and then the question is, of course, who makes the prices, who makes the returns? Yeah? From this pattern, it seems like people like me are more important, yeah, than people like Musk. Yeah? Because in history, yeah, it was really more risk was rewarded, yeah? But it seems to be that it was basically, yeah, that diversification, yeah, is something that many people enjoy, and we will see it in a minute. Yeah? So in the there are many models of the capital market, yeah, but this is by far the most prominent. Yeah? The capital asset pricing model, invented in 1964, and still basically the workhorse. Yeah? In your asset pricing class, yeah, you saw that there are many more models, yeah, multi-factor models. Yeah? The CAPM is a so-called one-factor model because only the market portfolio is the only factor that drives the thing. Yeah? So it's just one model. Yeah? It's only that it has become basically the most dominant model in the market. Yeah? And the CAPM basically says there are two kinds of risks: yeah? Firm-specific risk and systematic risk. And systematic risk is market-wide risk or common risk or undiversified risk. It is basically the risk that you have if you invest into the stock market portfolio. Yeah? If you invest into the stock market portfolio, then maybe the CO2 prices go up, yeah, because the world is going to less carbon. Yeah? That's bad news for steel firms. Yeah? They need a lot of energy and their stock prices go down. But it's good news for solar panel producers. Yeah? Their stock price goes up. Yeah? If such a shock happens, yeah, the carbon taxes or the carbon prices have been increased, yeah, then you are not hit, yeah, because you are well diversified. You have both the steel companies that suffer from this, but you also have the solar panel producers that benefit from this. Yeah? So this is not, yeah, if you have these positive and negative effects, yeah, then basically you enjoy diversification benefits. Yeah? But here, yeah, the steel operator and the solar panel operator, they have higher risk, yeah, because they are really hit by this, or maybe hit, yeah, depending on the direction. Yeah? And yeah, but then there was other risks like market-wide risk. If there is war between Russia and Ukraine, yeah, then basically maybe many things are destroyed, many values are destroyed, yeah, and if you are the owner of the world market portfolio, yeah, and you see, yeah, these assets are machines and you see bombs falling on your machines, yeah, no matter what company you own, yeah, you will lose money. Yeah? This is a market-wide risk. Yeah? When artificial intelligence is basically a new technology that helps all businesses to become more profitable, yeah, this is a positive risk. Yeah? And all your assets, they become more valuable simply because AI is increasing the value. Yeah? So this is what we would call the risk that we have to take. Yeah? AI as an opportunity, war as a threat, yeah? But it's all causing volatility, and you can't diversify this away. Yeah, but firm-specific risks, yeah? Risks that are uncorrelated, and mainly that affects only particular security, that is clearly can be diversified away. Yeah? Suppose Elon Musk today crashes in an airplane accident and he dies. Yeah? That is clearly bad news for the Tesla owners. Yeah? The assets of Tesla will clearly decline, yeah? As do the X share price. Yeah? And every day, of course, some airplanes crash and some CEOs die. But if you have the world market portfolio, then you are more or less risk-free, because it's you have one CEO dying every day, but that is almost for sure. So diversification basically means that the uncertainty is taken out. And this is basically the diversification effect. And now the CAPM basically says only the systematic risk is basically the risk that is threatening us. As a diversified investor, I simply can move this out. We can destroy firm-specific or idiosyncratic risk simply by diversification. I think this is the best word. If I can delete it by diversification, it's not a risk that I suffer from. And I only charge a risk premium on the risk that I really suffer from, that I have to take. And undiversified risk is inevitable. If you invest in the stock market, this risk is for sure your risk and you should take it. So in large portfolios, the firm-specific risks will average out, will be diversified, they simply go away. And the systematic risk is what stays. Now every firm has both. It has some systematic risk or market-wide risk and some firm-specific risks. And only this, the unsystematic risk goes away. And only the systematic risk remains. So the systematic risk, I think the complexity really is only comes from the many different words that we have for the same thing. But we have only two buckets. One is called the systematic risk bucket, and the other is the unsystematic risk bucket. And in a nutshell, you can simply assume systematic risk has a cost, maybe 5%. That's at least, I think most practitioners use something between 5 and 7%, depending on which country you are. This is what, you just go back here. S&P 500, 12%. Treasury bills, 4%. There seems to be something like a 5 or 7% difference. So most practitioners basically say systematic risk costs something between 5 and 7%. And if you are living in an emerging country, and people say the capital market is not working so well, maybe we charge a bit of higher of a risk premium in a well-developed market like the US. You usually take these values and also and unsystematic risk, that is a surprise. It's really zero. The risk premium of unsystematic risk is assumed to be zero. Simply because people like me, we are diversified and I don't care. Because it's really one apple tree has more apples, the other apple tree has less apples, but I'm only concerned with the overall harvest. Really think about, it's a good idea. This apple tree idea is, the world market portfolio is all apple trees that we have on the earth. And if climate risk comes and there is no more rain or too much heat, then the worldwide harvest will decline or increase. And that is the risk that I fear. But everyday little farmer has its own single apple tree, or maybe a yard with 10 apple trees, and he has very specific sorts of apples, green apples or red apples, and he may be affected by local weather, by whatever thing, and that is his unsystematic risk. I simply don't care. I only care about the overall harvest of the world, because this is what I have an own stake in. Because I'm not the owner of the whole world, but I have a very small. I invested my portfolio in every apple tree of the world, and that's really, it's really true. You can easily invest into all these shares, and I have shares in the US, I have shares in Europe, I have shares in China, and whenever I have an investment, even if I invest only $1,000 in an ETF, that $1,000 is invested in hundreds or even thousands of shares. So diversification, early on people said, but you need to be rich in order to diversify. It's no longer true. Even if you are a small private investor like I am, you can easily diversify, and most people actually do it. When I was young, most of my friends would invest in single stocks and would say, oh, I believe that Microsoft is a great firm, I put my money on Microsoft. When I was living in Vietnam in 2008, that was really a crazy thing. There were office buildings in Ho Chi Minh City where you could go in at 9 o'clock in the morning, you bring your money in the pocket, you put it on the table and say, I want to invest in VinFast or in Viettel or whatsoever, and then you bought some shares at 9:30, then you saw on the screen whether the shares would go up and down, and you saw, oh, I made some money, now I sell. And then you got your money back. And at 5 o'clock in the afternoon, everybody was going home, and of course he had sold all the shares in between. So there was pure day trading. You just invest from 9:30 to maybe 2 o'clock or 4 o'clock in the afternoon, and you hope to make some money. Zero was invested overnight. Somebody else, it was simply not possible to invest the money overnight. It was really like a casino. And in the early days of the Vietnamese stock market, it was always going up, and people were quite crazy about this kind of investment. Many people had free time and went to this kind of broker offices every day, of course, until the stock market collapsed, and then the game is over and nobody invests anymore. This is a low developed stock market. Then comes the phase when you have your brokerage account and you invest in maybe VinFast or whatever, and you hold single stocks. And it costs you quite a lot of transaction costs, just to open the brokerage account, to make this acquisition of one single share. But then the next phase is that the transaction costs are almost zero. When I buy the S&P 500 in an ETF form, I think the transaction fees are $5 or so. So if I invest $10,000, $5 is almost nothing. And the management fees and then all other fees are also almost zero. So today, transaction costs are so close to zero that you don't even take them into account anymore. And the only question is, where do you want to invest? Do you want the MSC 500, the S&P 500? Do you want the Chinese stock market, or the MSCI World Market Portfolio, whatsoever? So in Vietnam, of course, there were capital export restrictions. If you say, I want the S&P 500, the Vietnamese government says, but I want that the savings of Vietnamese people stay in Vietnam. And this is most important in China. The biggest savers, the biggest investors are Chinese people. They save like hell. They earn a lot of money, and they save a large part of their money. But the Chinese government makes everything to keep the money in the country, and to prevent people from exporting to that country. And basically, if you buy American shares, that means, of course, Chinese savers' money is going to the United States in order to fund projects in the United States. So the CAPM theory basically assumes that there were no such capital controls, and that everybody acts like me. And this is true, clearly not for Vietnamese and Chinese shareholders. It is clearly not true for Elon Musk and private equity funds. But it is true under CAPM assumptions. And it is the underlying assumption of almost everything that we do in valuation. So this basically is the story of the CAPM. What was told in the financial textbooks, and the deviation in reality, that there are capital controls in countries like China and Vietnam, and there's the thing that there are big individuals who have concentrated stock holdings for other reasons, that is basically ignored, I would say. Yeah? And then people would say, yeah, it is there, but it's not that important that we have to change this theory. Yeah, and then the risk premium for diversifiable risk is zero, simply because that risk is gone away. Yeah? If you don't bear it, why should you pay for it? Yeah? It's like the law of large numbers. Yeah? If you have, if you're in insurance and you insure all the cars that have an accident one year, yeah? For every single car, it is a high risk thing. Yeah? You may either have an accident or you may have no accident. Yeah? But countrywide, the number of accidents are almost stable and safe. Yeah? If you just look at the overall number of car accidents over the last years in Vietnam, yeah, this is a very, very steady development. Yeah? So suppose you are the monopoly, only state insurance company, yeah, that insures all the cars, then you would say this is an almost risk-free profit. Yeah? You collect insurance payments from all the people, and you pay all the damages for the, if there is an accident, yeah? And as long as the number of accidents in countrywide, yeah, should not suddenly go up and down, yeah, there is no risk. Yeah? And quite many insurance contracts have this kind of feature. Yeah? The law of large numbers really apply, and the risk is gone. Yeah? And here in the capital market, yeah, we have some risks where the law of large numbers apply, yeah, where the risks go away through diversification, and we have other risks that stay. Yeah? Like, yeah, climate change affects the overall worldwide harvest of apples. Yeah? This is a systematic risk. Yeah, and then of course, yeah, why is this happening? Yeah, if there would be a risk premium, yeah, then you could earn this additional risk premium, but basically get an extra return, like an arbitrage profit. Yeah, so from the theory point of view, yeah, it must be zero. Yeah, if you don't bear the risk, if the risk goes away, why should, yeah, people would become rich if there would be a risk premium? Yeah, but in the end, it's a nice logic, but there was also a lot of empirical research on this, and yeah, it's interesting. There was some word that we call arbitrage. And arbitrage is basically a profit opportunity with roughly zero risk. In the next class of Fabian Löbbeking on financial derivatives, yeah, options and futures are only priced by the absence of arbitrage. Yeah? Basically, the theory says we don't have to make any assumptions. We can value options and we can value all kinds of other derivative principles simply by assuming that this arbitrage opportunity should not exist. Yeah? If there is an arbitrage opportunity, yeah, then we mean that somebody can make a profit without taking on risk. Yeah? Approximately zero risk, that means a risk-free profit. Yeah? Risk-free profit is what everybody likes, yeah? So everybody is investing and buying the one thing, and then the profit opportunity is quickly exploited. Yeah? The prices go up, and all the people buy something, and there is no arbitrage opportunity. Yeah? This sounds a little bit like an arbitrage opportunity, but for good reasons our textbook doesn't call this an arbitrage opportunity. Yeah? But in the strict sense, it is an arbitrage opportunity. Yeah? If there would be a risk premium on diversifiable risk, yeah, then you could create portfolios with very small risk, yeah, that are still earning a risk premium, yeah, and this is something that should not happen. But this arbitrage is not, well, the question is always, yeah, is it really zero risk? Yeah? So, yeah, if an option on IBM is wrongly priced, it's too cheap or too expensive, yeah, then you can build an arbitrage portfolio where IBM shares and options of IBM are included, And the theory actually tells us that it's really zero risk. It's absolutely risk-free and makes a profit. Yeah? And it's convincing to assume that this cannot happen. Yeah? But in this undiversified risk, yeah, you may say, okay, if I go long in steel and I go short in solar panels, no, bad example. This is not risk-free. Maybe something like this. Yeah. This is basically a bet. Yeah. If you are optimistic about steel companies in the US, yeah, but you don't want steel industry risk, yeah, then you short steel companies like Mittal from India. Yeah. Then you long short portfolio, yeah, which is almost risk-free. Yeah. And the question is, can you still earn a risk premium on this? Yeah? But the risk of this portfolio is clearly zero. Yeah? There was a substantial risk remaining, yeah? And therefore eliminated, yeah, is a strong word. Yeah? Yeah? In the literature we call this the limits to arbitrage. Yeah? Only in the theory you can really destroy the risk. So the CAPM basically is very bold and says unsystematic risk has a zero risk premium, full stop. Yeah, yeah. So the risk premium on security is only determined by the systematic risk, and the stock volatility, yeah, is a measure of total risk, systematic plus unsystematic risk. Yeah, that is not a good thing, yeah, as we saw on the first slide, yeah, where the this is volatility as a measure. Yeah? And if we have single stocks, yeah, then we basically say the volatility of 40% of that single stock is our risk measure. Yeah? But it's not, but this dotted line is basically the relation between risk and return. Yeah? And this single dot is way below. Yeah? So the standard deviation is not a good risk measure, yeah, simply because it contains both idiosyncratic and systematic risk. Yeah? So the idea is, yeah, the standard deviation is a bad risk measure. Yeah? We want a measure of systematic risk. Yeah? We need to basically divide this risk into the two components. Yeah? What is the systematic risk and what is the unsystematic risk? Yeah? So can we split up, yeah, this standard deviation into two parts? Yeah, and the result, the answer to this question, which is the result of complex mathematical computation, yeah, that we do in asset pricing. In your asset pricing class, if you dive into it, if you really understand the mathematics, yeah, which most people do not, but then you can basically see, yeah, that in a mathematical term, yeah, the risk can be really separated into two things, and beta is basically the systematic risk. So, yeah, beta, which is the covariance between the stock and the market divided by the standard volatility of the market. Yeah, this is the definition of beta. It's a well-defined mathematical concept. You may still, it's unknowns, of course. Nobody knows the covariance. It's all about the future. Yeah, we can measure historical covariances, yeah, but of course we think about, yeah, if you buy a stock right now, what is your estimate of the future covariance of Tesla and the market, and what's the future variance of the market return? But yeah, and it has a nice interpretation, yeah, because it is also, yeah, this beta is not only covariance divided by variance, it is also the slope of a regression line. Simply because if you regress, one variable x, one variable y, then the slope of the regression is beta. Mathematically, it's absolutely the same. The so-called ONS estimate of a linear regression is exactly the same formula. So two interpretations for the same mathematical formula. So KEMM says beta is the measure of systematic risk. Beta basically measures how one specific this is the S&P and the market, and this is Tesla, and basically, the other way around. This is the S&P. This here is Tesla. Then intuitively, the beta of Tesla tells you how strongly the Tesla stock reacts to the S&P 500. In terms of in a kind of regression, where we put the right things into. Beta obviously differs from volatility. Just believe me that beta is actually a good measure of systematic risk only. And when you say how sensitive the underlying revenues and cash flows are to general economic conditions, then actually what you mean is how is the Tesla stock price related to the S&P stock price? Because this is the only data that we have to feed this. And of course, our theory tells us that Tesla stock price is driven by revenues and costs going up and down, and the market is driven by general economic conditions going up and down. But it's just a rewording of the thing. And then the question is, of course, which are the stocks that have high betas? General economic conditions is, of course, if you think about what affects the whole market, many things come into your mind. One is the business cycle. In a recession, all firms are doing bad. In a boom situation, all firms do well. But this is, but not all firms are that cyclical. If you are an energy producer or a producer of rice, the amount of rice eaten and produced is almost stable. And also the profits of a rice producer do not depend. So rice production is clearly non-cyclical. But car production is. In a recession, few people buy cars. In a boom, many people buy cars. So VinFast is a typical cyclical industry, and they will move up and down with the economic conditions. So our gut feeling is the more cyclical you are, the more your business depends on the general economic condition, the higher your beta is likely to be. So Tesla and VinFast are likely to having higher betas than a company that is producing rice. But we also said before that general economic conditions is also something like climate change. If climate change basically makes the whole world worse off, then the climate change is also a risk factor for the whole. And the companies that suffer a lot from climate change have more systematic risk, and companies that do not suffer from climate risk will have less systematic risk. Let's have a break now. 12 o'clock, 1 hour lunch break, and then we continue.